Episode 24. We usually have 24 ribs and 24 vertebral bodies in our cervical, thoracic, and lumbar spine. Beginning in 1924, the Dow Jones Industrial Average almost quadrupled over the next 5 years. Age 24 was the first boys' trip to Vegas, and the Montreal Canadiens have won a remarkable 24 Stanley Cups. Beyond MD, episode 24, here we go! Hey everyone, and thanks again for joining me on the Beyond MD podcast. I really do appreciate it. So let me start this episode with a question. What is your greatest investment? Is it an ETF, a stock, an investment property? Well, the answer should be you. Think about all the time that you put in to get to where you are today. Your greatest investment is yourself, all the effort you put to get here, and your ability to work. So we need to talk about ways to protect ourselves. And so today we're going to be diving back into the world of insurance, and the topic is going to be critical illness insurance. So going forward, I plan to do a solo episode once every quarter. And what I want to do in those episodes is talk about a subject that goes beyond just finance, something that's relevant not just to our financial lives, but also to our personal and professional lives. I'll also be taking time in those solo episodes to review some of the more recent episodes and covering some of the high yield points. And the next solo episode will be in April, and in that episode, I'll talk a bit more about critical illness insurance, specifically my policy, what I did well in securing that policy, but more importantly, things that I could have done better, because I do want people to learn from my journey as well. So to help me tackle critical illness insurance, I have Mehul Gandhi, who is a certified financial planner, tax and estate practitioner, and licensed insurance advisor. Mehul works with business owners and medical professionals to make sure three things are protected: their family, their income, and their legacy. Mehul's expertise in tax and estate planning allow him to work together with his clients' other advisors to create unique customized solutions and plans. Mehul is also the founder of the Mind Your Biz podcast. And guys, this is a phenomenal podcast. He's done a really good job with this, and it's where he interviews business owners and experts on various business topics. Mehul and his family live in beautiful Coquitlam, BC, where he enjoys golfing, cycling, wine, and more golfing. So Mehul, if you're listening, remember that those are all things that I enjoy too. So when you're in Ontario, please hit me up for a round. And that goes out to everybody else listening. If you want to play golf, please think of me, message me. I would love to play with you because I got out 5 times last year, 3 times the year before that. I clearly need to get out more. Now, as always, any conflicts of interest have to be acknowledged. So Mehul is a licensed insurance advisor, but the podcast is about education and demystifying, and the same holds for this episode. And as you'll see, there is no sales pitch. Here's my interview with Mehul Gandhi. All right, Mehul, welcome to the podcast. Where does the podcast find you?
Hey, Yatin, I am in Coquitlam, British Columbia. I'm at my house. This is sort of a little studio I've created in my home office here. We moved here in September, end of September, to this house in this beautiful neighborhood. And it's a beautiful day outside. I don't want to make you too jealous, but
yeah, I think the roles have reversed. You guys are finally enjoying the good weather that you deserve. Well, we had about 40 to 50 centimeters of snow this week, but we had it coming our way, so it's all good. Yeah, but I think you are my first guest from BC. So Mehul, listen, it's great to have you on. I'm really excited for today.
It's a real pleasure.
Yeah. So Mehul, maybe just take a second, give us a quick snapshot of your background and just who you are.
Yeah, absolutely. I am a financial planner, a certified financial planner, so that CFP designation that I know you're familiar with. I am, my focus is more around tax and estate planning, specifically for business owners and medical professionals. And I self-profess to love insurance. I grew up in the industry, so to speak. I had family in the industry, so a lot of our dinner table discussions revolved around insurance. But little known fact, my initial sort of dream as a kid was to become a doctor. Wrote the MCAT twice.
Oh, wow.
Let's just say it's a lot harder. So a lot of respect for physicians and just, students in medical school. And so it wasn't for me at the end of the day. But I knew that I always wanted to be in front of people on a daily basis. I wanted to, whatever I did, to be not just helping people, but really be interacting with people face to face, not behind the scenes. I'm super competitive. Grew up as a competitive athlete.
What did you play? What did you
I
play?
played a ton of baseball early in Toronto. I grew up in Mississauga, and then moved over to basketball. And was fortunate enough to play for a high school team where we had a couple players that ended up going down south to play Division One.
Wow.
But while they were being recruited, we got to tag along to a lot of these tournaments down south that I had no business being at. So, playing with people, with some of the Raptors fans out there might recognize these names. Tracy McGrady was someone I played against.
Oh, no way.
Steve Francis, who played for the Lakers for a bit.
Yeah.
Chucky Hayes, Charles Hayes, who I think played for Houston, went to Kentucky, go Wildcats. He was a roommate of mine and at a camp. So I got to play with these guys, and it just taught me, what it was to dig deep and be competitive. Even if you weren't the best player on the court, you just had to fight for every inch. And I'm a competitive person. So an industry like I'm in, that's, definitely a lot of competition in the industry. There's a lot of different people, doing what we do, finding out ways to stand out, to be on top always. And whether that's through education, whether that's through marketing, whether that's through just the way you interact with clients.
I was going to say we have some similarities. We're both Indian. We both have shaved heads. We both have a bit of a science background. Wrote the MCAT, but then I think it stops there. When you started talking about Tracy McGrady, I think you just took it to a whole new level. So,
I think we should note for the audience, not only do we both have shaved heads, we wear it really well, both of us.
Yeah, I think so, man.
I
think you're better looking than me. Anyways, I'll take it. Okay. So let's get into insurance now. Let's just dive right into it. So I think of all the insurance options, like disability insurance and life insurance are better understood. And I think critical illness insurance may be a little less discussed. But one common scenario I kind of hear is, okay, well, if I suffer an adverse event like a heart attack, then I'm going to be disabled and my DI, my disability insurance, should kick in. But I think the truth is probably not the case. So maybe, Mehul, you can just kind of help us demystify critical illness insurance. Like, what is it? And then what are the fundamental differences between critical illness, CI, and disability insurance, DI?
Absolutely. I think the best place to start is actually on the DI or disability insurance side. Disability insurance, I think, like you said, people are familiar with it. Mainly because a lot of employers, larger employers, will offer LTD or long-term disability insurance, which is essentially the same thing. But what we have to understand is what has to happen for a claim to occur. And when it comes to disability insurance, there isn't one illness or particular type of injury or ailment or condition that triggers it. It's really about, have you lost the ability to perform the duties of your occupation? Okay. Now, obviously, this is due to some type of medical issue, whether that is an injury, an illness, mental health, or stress induced. That's what sort of justifies or leads you to being able to make a claim. Okay. Now, we can see the breadth there. When we move over to critical illness insurance, it's typically based on a diagnosis of a particular disease, illness, or ailment, which is given or provided to the contract holder, the policy holder, in advance. So you do know, or should know at least, what illnesses, conditions that your critical illness insurance policy covers in advance. And if you are diagnosed with one of those, then you can go ahead and make that claim. So that's the big difference between CI and DI, right? Now, right off the bat, someone listening might say, well, can't they both pay out in the same time? Like, what if the thing that leads me to not be able to perform the duties of my occupation also happens to be on the list?
Exactly.
And the reaction I typically get to that question, or the assumption rather that people have, is no, insurance companies never double pay. That's not going to happen. Like, that's unheard of. But in this case, it does, because there is no conflict there. These are two different types of coverage. One could say the purpose almost behind them is slightly different. And the disability insurance is considered an income replacement, whereas critical illness insurance is not considered income replacement. We're really trying to make up for the expenses associated with that illness. So in this case, over and above what your income is.
Okay,
Right.
perfect. I think that's a really good summary of the two of them and the role that critical illness will fulfill. So maybe let's dive into the specifics now. So in terms of how much critical illness coverage we should be getting, are there any general rules of thumb that we maybe should be following?
Yeah, that again, I think that the general rules are a good place to start, but we have to really eventually at some point in the conversation get specific about our particular needs. Now,
Yeah.
life insurance is one of those things where we can get a calculator out. We can, understand how much debt you have, what your income replacement needs are, how many, the age of your children, if you have your mortgage, all that kind of stuff, and get you a pretty accurate number as to what you need today. With critical illness insurance, it's not quite so simple, right? Because, well, we don't know what the costs associated with whatever illness you might or might not get in the future, what those expenses are going to be. So what we'd like to say is, let's just assume that you're not going to be able to work for 6 months, or you're going to need this financial support for 6 months. Maybe it's a year, maybe it's 2 years, right? So it's really important to sort of see what those numbers look like, because the determining factor in my experience with critical illness insurance is affordability. Mm-hmm. Okay. So I'm going to show a client, here is what a 6 months worth of income looks like. So coverage that's going to replace 6 months. Here it is for a year. Here it is for 2 years. Right. So this might range from, $100,000 policy to a $200,000, $300,000, $400,000, $500,000 policy, depending on your income, of course. Even higher. And let's look at the costs and let's see what you think. Now, the person's going to say, okay, well, I think that it's reasonable to assume that 1 year I should be back on my feet in about a year. Okay, that's right. That might not be the case though, right? Mm-hmm. You might end up getting something that you're never back on your feet. You're never going to be able to go back to work, right? But how do we account for all of that? Unless your budget, so to speak, is really high, and we can go and max out and get as much critical illness insurance as a carrier or carriers are willing to give you, I always say something's better than nothing, right? So if you got the 200,000, it's better than 100. If you got the 100, it's better than the 50. If you got the 50, it's better than having nothing at the end of the day.
Okay, I think that's a really kind of reasonable approach. Now, some people may argue and say, well, we live in Canada, where a lot of things for us related to healthcare are going to be covered. And what if we're the type of individual that has an emergency fund in place already? Do I need critical illness insurance at all? Like, I hear this. I'd love to hear your take.
Yeah, I love that. I mean, I love it when clients come and say, I have an emergency fund. Okay, that's great. So how many months of emergency funds do you have? Yatin, I'll be honest, I might see a 6 month emergency fund. Typically it's 3 months. Typically it's 1 or 2 months.
Okay.
Right. As young Canadians, regardless as your profession, as to what your profession is, it's expensive out there. So having that cash on the side doing nothing for you, completely liquid, A, is rare. And B, if you do have it, a lot of my clients are like, I'm kind of itching to use this for an opportunity that just came up. I kind of want to put this into real estate or into the markets or into a private equity, whatever it might come on their plate. Yeah. And so at that point, I start asking, okay, well, what if we just shifted that risk to the insurance carrier, right? Do you want to keep that $100,000 completely liquid, keep that powder dry? Or would you rather pay a monthly premium knowing that, X amount is going to be able to come to you in the event that you need it, and you can go ahead and invest some of that or a portion of that. So that sort of addresses that question. Now, if the person is adamant that, hey, listen, I've got this emergency fund, I don't need it, my investments are taken care of, this is literally on the side for that, then I'll always say, okay, do we need to top it up? We'll use that $100,000 example. Is that enough? Do you want to add another $100,000 critical insurance policy on top of that, so that if something does happen, you have some more flexibility there?
Yeah, for sure. And I think the reality is, Mehul, like, correct me if I'm wrong, but if somebody in the family suffers a critical illness, it doesn't just affect you, it's going to affect others around you, right? So, you're not going to be working for, right? So you're not going to be working for an extended period of time. A good chance that your spouse will not be. And so I think there's kind of a ripple effect to others around you. So
that's the biggest point, I think. This is the second point, which I think is so important to realize, where it gets missed, is that if something happened to me, God forbid, I'm pretty sure my wife is not working. She's going to be wanting to work less in order to support me, to take me to appointments, to be there for me. Right. But she can't claim on her disability insurance or on her, whatever it might be to take that time off, especially extended. She might have some sick days banked up or family compassion days, but eventually it's going to run out. Right. Here is the flexibility to say, listen, I can take time off work because my family member has come down with this illness and I don't have to worry about how the family is still going to survive financially.
Yeah. So maybe we can get into these policies. So when I was kind of going through the process, I came across some policies that would cover the big three: heart attack, stroke, and cancer. And then I saw some policies where it was 25, 26, or even more critical illnesses. So it seems like quite a spectrum. Just quickly, what do we need to know here?
Yeah, I mean, I think the big three, the heart attack, cancer, stroke you mentioned is not a bad place to start, especially if we're looking if budget is a big concern. We know that in the industry, around 89% of the claims are due to heart attack, cancer, and stroke. Okay, but that being said, a more well-rounded policy that's going to look at typically 25, 26 illnesses is obviously going to be that much better. Looking at the cost differences there. Now you want to really start looking at the fine print. Yeah. Okay. This is where we start looking at, okay, well, cancer is not just cancer, is it? What's the difference between carcinoma in situ versus, full blown stomach cancer or something like that, right? There's certain sort of less serious versions of an illness that are going to pay an advance payment. So if you have a $200,000 policy, it might pay a 10% payment for one of these less serious conditions. And if it blows in, turns into something larger, then the full amount will pay out. Now, in that respect, there's a couple of things to be aware of. There's certain policies that when they pay that smaller advance payment will reduce from the overall sum of coverage that you purchased to begin with.
Okay.
But more and more, we're seeing these new policies come out where that advance payment does not subtract from the overall amount. Okay. So it's good to know what you're signing up for. So you might say, okay, well, this one's a little bit more expensive than that. The company A more than company B, but then really realize why. Like, what am I paying for? And then just know.
I think that's some really good guidance. So as the host of the Mind Your Biz podcast, I think you knew this one was going to come, I think you're doing a great job with the podcast, by the way.
Thank you. Appreciate it. I really appreciate it.
So when it comes to critical illness, where should we be holding this? People are wondering, do we own it within the corporation? Do we own it personally? And then there's also the option of shared ownership. Maybe you can guide us on this a bit.
Oh, yeah, this is a big one. So I would say for most individuals, most of the time, owning it personally is the right way to go. Now, as incorporated individuals, like I believe you are, like I am, we've been sort of conditioned to say that to sort of pay as much as we can out of the corporation with corporate tax dollars because it's more tax efficient. And I'm a big believer in that. Trust me, tax is my thing. Corporate structure is my thing. I love it. I love to be able to assist my clients in making sure they're as tax efficient as possible with their cash flow and their earnings. That being said, we have to understand that critical illness insurance does not work the same as life insurance. Okay. So, and I think you've talked about this before on the show. Within corporations in Canada, CCPCs, they do have a particular notional account called a CDA or a capital dividend account where certain types of dividends can be paid out to the shareholders tax-free, right? One of those is the untaxed portion of a capital gain, a realized capital gain. But a common one is the proceeds of life insurance. So when life insurance is paid out from a corporation to a existing or surviving shareholder, it's paid out tax-free. Critical illness insurance benefits are not paid out tax-free to the ailing shareholder or to anyone for that matter. Does not qualify for the CDA. Okay. So when you think about that, now it's like, all right, do I try to save a few tax dollars by holding my CI inside my corporation, or is it more efficient to hold it outside my corporation? Because if I ever need it, I don't want to be taxed on this big lump sum. Okay.
Yep.
Now, here's where it gets a little bit more complicated. What's to say that if you do make a claim that you need to take out that whole lump sum right away? You might just need to take out a little bit at a time. You might actually recover relatively quickly, and there is no need for the big $300,000 payment. That can sit inside your corporation. You can actually help your corporation sustain itself.
Okay.
Right. If there's certain expenses associated with your corp, if you own the clinic you're in, and there's lease payments or certain obligations that you have to make while you're there, your corp has the money to do so. And you can just pay yourself as you would normally as a taxable dividend. And that might just end up being the same thing. So it really is a personal choice. We need to go through each scenario. I'm a big spreadsheet guy. Put it in the spreadsheet. Let's look at the difference, and then let's make an informed decision. Then there's that third growing in popularity, shared ownership, or sometimes known as split dollar critical illness insurance. This one is interesting. Okay. We're trying to apply a strategy that was typically used with life insurance to a critical illness insurance policy. So in order to explain this, we have to back up and explain one of the most popular, add-ons or features of critical illness insurance is the old ROP, or return of premium.
Right.
And this answers the question, what if I don't get sick? Right. Because we know life insurance will pay out, but not everyone's going to get one of those illnesses on the list there in your critical illness insurance policy. So what happens? Some policies allow you to add this feature called a return of premium, or ROP, where at a particular time, either at maturity or upon cancellation, maybe expiry, maturity might not be the right word, you will get all your premiums back. Now, there's no growth on that. It's not like a cash surrender value on a whole life policy. It's just your money coming back to you. So that, you paid with after-tax dollars, you're getting your money back tax-free. Now we're gonna utilize this in this split dollar shared ownership strategy, because there's a cost associated to adding this return of premium feature.
Okay.
So what we're going to do is we're going to share the ownership. We're going to create this product that has a critical illness insurance benefit. Let's call it, $300,000, and a return of premium benefit. And there's a total cost for this package. We're going to split the cost. We're going to essentially have the corporation pay for the benefit, the cost of the benefit, and we're going to have the individual pay for the cost of the return of premium feature.
Okay. Yep.
Okay. So we've shared the ownership, or we split the product essentially. If we get to a point where the plan is expired or whatnot, and the insured individual or the corporation decides to cancel the plan, there's a return of premium. But who gets that money back? Well, because the individual shareholder has been paying for the return of premium with their own personal after-tax dollars, they're entitled to all of the premiums back. Not just the premiums that they paid, their portion, but also the premiums that the corporation paid. Get all funneled to the individual shareholder tax-free. So we are using essentially tax rate arbitrage. If you want to get super fancy, we're using that advantage there to sort of have that money come out of the company in a tax-free way.
That's very interesting, because when I signed up, I wasn't aware of this. Somebody told me about it. And then I've heard about some people saying, this sounds like an amazing kind of tax sheltering mechanism. Let me load up on CI. But then I just wonder at the back of my mind, is that really the right way to be thinking about it?
Yeah, it's such an important question that you ask. I mean, at the forefront of every decision here, regarding this critical illness insurance policy is there a need for this coverage? Right. What is the need? Right. And CRA will apply this. They're always going to look first and foremost, was this done as a tax strategy first, or was this done as a protection to protect the business and the business owner? Yeah. Right. And it better be the second one. You better, you should be very clear to CRA that the purpose of this policy was to first and foremost protect the shareholder and the business in the event that the shareholder gets an illness. So keep that in mind. The second thing is structure. There are certain things that need to happen, with your shareholders agreement, in your corporate minute book, the way that the premiums are being accounted for and reconciled by your accountant and bookkeeper, the way the taxes are flowing, even the way you pay the insurance company with one check or two split checks. All of that needs to be accounted for. Certain tax professionals will even actually go as far as to get a proper valuation of the policy to make sure that the payments being paid by the individual and the corporation are fair and reasonable, or would be fair and reasonable in the eyes of CRA. I don't know if that's always necessary. I don't know how much, that needs to really happen all the time. But you know what? If you are really wanting to make sure this thing is buttoned down, it's something to seriously consider. Now, it's one of those things where the more moving parts you have, the more you need to really slow down and make sure that this is the right thing for you and it's being done the right way.
I think that's a really practical and very helpful approach, Mehul. So thank you for that. Now, you mentioned return of premium, so we understand what that is. What's your take on return of premium? Because I know some people who say, I love return of premium. Nothing happens to me. I'm going to get my money back. But then I think it adds a certain amount of cost too. So what's your approach when you have two policies, one has an ROP and one doesn't?
Yeah, I always want to go to the stats, right? I always want to sort of impress upon the applicant or the client that this is how often claims are made and paid out. This is the reason, right? What is your reason for getting this policy? Do you really think it's going to pay out? Or do you really think you're going to make a claim on this rather? And if so, then why are you getting a return of premium? Right? Yeah. Can we maybe use that money to get more coverage?
Yeah.
Are we sacrificing the amount of coverage that you would ideally need or like to add this nice feature, this nice to have, not need to have feature? And I think that's the thing I really try to impress upon clients, especially if you're getting a permanent critical illness insurance policy that's never going to expire. So it's covering you for your entire life. I'd like to think that at some point, there's a pretty high chance you're making a claim here.
Yeah.
Right.
Yeah, for sure.
It's funny. Like, would you really want to get to the age of, say, 75 and have this policy and be like, nah, I'm just going to take my, return of premium at this point, when like from 75 to like 95 is the chances of getting a claim go up so much higher. Like, so you really have to kind of, I think what has to happen is that a lot of times when I sit down in front of a client, they've got all this information already. There's information out on the web. They've spoken to friends, neighbors, maybe other advisors, maybe their accountant, whoever might have sort of said, this is what I've heard, this is what you should get and all that. And I think it's really important to sort of slow down and say, okay, let me explain everything to you. And then let's make an informed decision after that. So I think that's the right way to go.
Okay, no, I love it. And one other thing I want to ask you about. So I've heard about this one term, loss of independence. What does this mean? Is this something that comes with most policies as things stand today, or is this something we need to actively ask about?
Yeah, so that differs. A lot of companies will have it included as one of the conditions, one of the 25 or 26 conditions. It's important to ask about. This sort of came out of a product that existed in Canada up until a little while ago called long-term care insurance. And LTC or LTCI, which is very popular in the US, but works a little bit differently. Here in Canada, the way it was designed was it was meant to pay out a monthly benefit in the event that you lost your independence.
Gotcha.
And so that's losing 2 of the 6 ADLs.
Okay, perfect.
Right. And I think your audience knows what ADLs are, probably better than I do. Please don't make me repeat all of them. And so that went away because it just was not something that was, to be honest, it just wasn't being sold, wasn't being bought.
Okay.
So companies like Sun Life and Desjardins, they got rid of their policies or changed them significantly. And so if you have an older policy or grandfather policy, you're good. You have that. It's great, but it's very hard to find now in Canada, almost impossible. So now they have this sort of, this sort of one of these conditions on the critical illness insurance policies that kind of simulates that. It's essentially taking your lump sum benefit and turning it into like a monthly, modal payment, that's going to help you if you do lose 2 of the 6, ADLs. Okay. Good to know that if that's something you're interested in, it's good to ask if it's included or if you have to pay extra for it.
Okay, perfect. So Mehul, we talked about how a critical illness can kind of have a ripple effect and it can affect essentially people around you. And so when I think about the family, I think about the kids as well. And so some people ask, well, should I be placing a critical illness policy on the kids as well? I'm just wondering, How often are people considering this, thinking about this, and what should we kind of be thinking about when we're trying to decide on this issue as well?
I think that some professionals in my industry will bring this up all the time. They will always bring this up. And quite frankly, it's our duty to make clients aware of what is out there. Because a lot of times they never would even conceive that a product like that exists. Right. But in certain instances, it does, I've had, at least in my experience, I've had a couple of instances where the reaction from the individual, from the client, has been negative. How dare you mention that? My child's not going to get sick. This is not something very pleasant to hear. And unfortunately, we know, and your audience definitely knows, that the reality is it happens. And it happens, in a significant amount of time, enough to at least think about this coverage. Now, I recommend there are two companies that have, I think, really good policies when it comes to critical illness insurance for children. They're specifically designed for children. And really, there's two different types of policies. Sorry, not two companies, but there's two different types of policies.
Okay.
One type of policy is going to be a standalone critical illness insurance policy that can only be acquired if you're under 18, but the coverage lasts your whole life. So you're never going to have to tinker with it. You're never going to have to change it, reapply, do anything. Typically, when I recommend this plan, I look for the paid up option. So it's paid up in 20 years, but the individual is covered. The child is covered until forever. Okay. So if you think of a newborn or someone that's a child that's quite young, they purchase, the parents purchase it for them, or grandparents purchase it for them. Child is protected by in 20 years, it's paid up and they're covered all the way through. And these policies will also include additional illnesses that you can pay for that are specific to children.
Okay.
Diagnoses that are typically made early on in life.
Yeah.
That being said, there's another type of policy where you get the policy while the individual's a child, but once they turn 18, there's a change in rates. Okay. Yep. First and foremost, there's no smoker, non-smoker for children. It's a blended smoker, non-smoker rate. Or some companies will just apply a smoker rate to children because there's no difference, or there's no non-smoker, so to speak. But then once they reach 18, they now have to reapply or demonstrate that they are in fact non-smokers to get that non-smoker rate. They might have to turn it into an adult type policy. I'm using air quotes here, so that child policy no longer applies.
Gotcha.
So it's a little bit of extra work when the child turns 18.
Okay. Perfect.
That's the crux of it. I think it's not a bad thing to explore. And if you're looking to protect your child, I actually would probably look at this before I look at a whole life policy for kids. I know that's a very popular thing to do. And I think it's a great strategy. I think it's a great decision, but I would think just based on risk, what's most likely, what's the best protection for your child? If you don't look at it from an investment standpoint, but from a protection standpoint, I think that a critical illness insurance policy for a child, especially that's going to last their whole life, is a prudent thing to do. And in case, one of your audience might be wondering, you can add this return of premium feature on the child policy. Okay. So later on in life, if the kid doesn't want it anymore, then you get the money back.
Okay. I think that's a really good overview, Mehul. Thank you. So we like to go into these conversations just as equipped as possible. So when we are considering this a critical illness policy, and we want to be asking the right questions, are there any must-ask questions that we have to bring to the forefront, beyond what we've already covered today? Anything at all?
Yeah, I think one of the things that your audience has to understand about the insurance industry, especially here in Canada, is that insurance is not bought, it's sold. Very few people wake up in the morning and say, I need to buy some insurance today. It's just not where our mind goes. It's not a pleasant topic to think about. It's not an expense we like seeing come out of our account every month or every year. Yeah. It's one of those things that typically you are introduced to somebody in my industry, or you are another professional in your sort of advisory team is saying, hey, listen, I think you need to get some life insurance or some disability CI. This is something you need to consider. There's a risk out here. Maybe it's a lawyer or an accountant or a bank or someone like private banker that's saying, hey, listen, I think you need to really look at this stage in your life. And then you typically have to be shown and kind of, I don't want to say talked into it, but you need to kind of be held through the process, right?
Mm-hmm.
So a lot of people don't know what questions to ask when they get to that meeting because it's not something they've actually really done a thought about. It's not something that they're seeking out. When I'm going to go buy my new TV, I have done all the research because I am stoked to buy this thing, and I'm nerding out on this thing. I mean, come on, I know more than the guy at Best Buy, right?
But you got to get the man cave ready, you know. So
exactly, or whatever it might be, right? So but in this instance, that's not typically what's happening. So I think there's two things. One, you should do your due diligence, do your research. CHLIA has great resources on their website. I believe the Ontario Securities Commission might have a little bit of information, Advocates or advisor.ca. I can even give you some links that you can put in the show notes.
Yeah, for sure.
For individuals to go out there and do their research. So that's the first thing, right? So depending on the product, with critical illness insurance, how many illnesses is it covering? What's this return of premium feature? How does that work? How should I own it? What are the medical requirements? What happens at claim time? Is this a fully underwritten policy beforehand, or is there going to be post claim underwriting? Right. And that's sort of one of those things in insurance in general. You really want to stay away from the post claim underwriting plans as much as possible.
Okay.
The next thing, I think the overarching idea is make sure you're dealing with someone that you really trust has your best interest, because there's a lot here. So at a certain moment, you're going to have to hand over that sort of trust and put that faith in that person that they're going to not only sell you, let's call a spade a spade. They're not only going to sell you the right product, but they're going to be there at the most crucial moment, which is claim time. What's the point of this if it's not going to be working at claim time, or if you don't have help at claim time? So that's where I would really focus on.
Okay, Mehul, let's shift things now to maybe some more big picture topics. Just heading into retirement, we talk about accumulating a lot, but then especially I think a lot of people who listen to this podcast, we're maybe not as familiar with some of the challenges that can come in retirement and the decumulation phase. So, when it comes to retirement, one term that we hear about is the sequence of returns. And so essentially, the portfolio can undergo different types of insults, whether it's a market downturn or an adverse event like a critical illness. And I guess the impact to one's financial health in the portfolio, it can kind of vary depending on when those events happen. If they happen earlier, might not be so good. But maybe you can just talk us through sequence of returns. Why is that important? And maybe what role can critical illness play in that setting?
Absolutely. I think critical illness insurance or critical illness, sustaining an illness in retirement is a really good example of the importance of, the severity that a sequence or a down market can have on retirement. So big picture, sequence of returns risk really is the risk that you sustain a down market early in retirement versus mid or late in retirement. So why is that a risk? If I had a PowerPoint, I would show you visually, but I will do my best to explain it.
Yeah, for sure.
And you can, your audience can kind of run this themselves, but it is mathematically true that if you sustain a loss early in retirement versus midway or later in retirement, giving a chance for your funds to accumulate that much more, it's going to have a more detrimental effect on your overall retirement income.
Okay.
Right. It's going to be that much harder to bounce back from that down market if you sustain it early in retirement versus mid to later. So what is that risk of the sequence in which the returns occur? And is your overall retirement income plan protected against that risk? Now, why does that happen? Why is that risk so? It is because in a down every year, once you're in retirement and you've gone into that decumulation phase, you need to now start withdrawing income from all of your retirement buckets or pools. I like to call them buckets.
Yeah.
All right. Now, if one or all of your buckets, if all your buckets are, all highly correlated, and there's for example, to the stock market, in the stock market, you have a down market early in your first couple of years of retirement. And that's also, so everything comes down in value. Your overall retirement portfolio comes down in value. you still have to live that year. You still need income,
Yeah.
right? If your burn rate in retirement is $100,000 a year, just because there's been a down year in the market, you can't just live off less. You still need that 100 grand to live off, so to speak. Right. So not only has your portfolio reduced because the market's come down, you've also taken 100 grand out of that same portfolio. And now we need to climb all the way back up so that you can continue to take that money out for the period of time that the portfolio was designed for.
Right.
Okay. Now let's throw a critical illness into the mix. Let's throw in the expenses associated with that illness into the mix, whether that's private care, whether that's out of province, out of country care or treatment, whether that's particular drugs that aren't covered by your particular province, whether that's spouse taking time off work who might still be working, or a child, or any kind of support. Right. So we're taking the regular income you need to take out to live in retirement. We had a down year in the market, and we need to fund this illness. Yeah. We have expenses associated with this illness, right? I personally would, as a financial planner, would love to be able to take that risk of that illness affecting my retirement, especially in a down year, and shift that risk to the insurance company.
Right.
So when I talk about critical illness insurance for those that can afford permanent coverage, I really like that, which actually ties back into that return to premium feature. Like, do you really want to pay for that return to premium, or would you rather get more coverage? Because in retirement, and if we factor in inflation, especially if I'm dealing with a 30, 40-year-old physician.
Yeah, exactly.
We're talking about, retirement to 20, 30, 40 years from now. Let's not even talk about the current inflation numbers, just based on, normal inflation. Is the $250,000 policy you're taking out right now, is that going to be enough? But I really want this return to premium feature. Well, do you need it? What if we actually get $400,000 of coverage instead? That might actually serve you better if something was to happen in retirement when you're not working.
Right.
Right. So that's how it all ties together.
I think those are really helpful considerations. And Mehul, correct me if I'm wrong, but in terms of the big three, heart attack, stroke, cancer, is it 1 in 2 Canadians now? Like, is that safe to say?
Yeah. It's funny. When I got into the industry in 2008, actually, what a year to get into the industry. It was 1 in 2.7 was the stat that we were always being told. Yeah. And most recently, I can remember in 2016 or 17, I remember hearing that it was 1 in 2.4 North Americans before the age of 65 will get a heart attack, cancer, stroke. So
the last kind of question, because I think we're now getting to that time where, it's hitting 40 minutes. So it's actually perfect. Longevity risk in retirement. So a lot of different risks that one will have to endure, market risk, but then there's also longevity risks. And so to me, the term sounds pretty intuitive. I think people are living longer. And how I know that is, I think the last time I was on call, I think we scanned a 108-year-old on our CT scanner. And I was just like, what is going on here? Obviously, people are living longer. So maybe talk to us about longevity risk. Kind of what do we need to know? And maybe how critical illness also kind of falls into play there.
Absolutely. And to echo that, I mean, one of my heroes and someone that we were always had so much respect for growing up was Mayor Hazel McCallion of Mississauga, who I think she's still alive. And I think she's either knocking on 100 or maybe even past that.
Oh, I have to look
that up. Active
maybe, yeah.
Tremendous lady. Wow, amazing. Can't say enough. But anyways, longevity risk, I'm part of a team. We are an ensemble practice. We all have different specialties and we work together. So 2 of the members on my team are portfolio managers, and they manage the investment, the asset management for our clients. And so this is what they do. I mean, they are, in my opinion, some of the best around. Longevity risk is one of the most important things we discuss with our clients, and that they will discuss when they're talking about asset management, right? Because in my opinion, I think it's the biggest threat to retirement in Canada today. Outliving your money.
Wow.
Living too long.
Yeah.
Living too long.
Interesting.
Okay. I think that, and that's compounded. And the reason I think it's the biggest risk is because I don't believe in general as Canadians, we're saving enough. And I think that due to, especially in the big cities like Toronto, Montreal, Vancouver, the cost of living and the cost of housing is so high that you're often taking debt into retirement. Now,
Mm.
one of the solutions is to work longer. And thankfully, because people are living longer and therefore hopefully having more of their life where they're healthy and able to work, they can work longer. That should help, right? We're not seeing that yet, right? I'm seeing a little bit of it. I think I see it a lot with physicians, working past 65 for sure, right? Because they're able, not necessarily because they have to. But I do think that longevity risk is something to really worry about. Now, if we start factoring into, again, just like the sequence of returns risk, what is the cost of surviving an illness?
Right.
Right. We talk about that very often. What is going to be the long-term effect and cost of surviving this illness? Right. You're now going to you're in retirement. You're not going back to work. That's for sure. Your retirement portfolio has taken a hit because you had certain expenses associated with this illness, but you survived. Mm-hmm. So now you're most likely going to have to reduce your retirement income, which is going to mean a sudden change in your lifestyle. Is that what you want?
Right.
Is that how you kind of want to? Is that how you envision your last days, your last years? Reducing your quality of life, changing your lifestyle in a way because of this longevity risk.
Mehul, those are really, really helpful points. And I truly do believe we don't think about it enough. And I think that stage of life, retirement, decumulation, the different risks that come with it, I think it's a whole different ballgame, whole different can of worms. So thank you for introducing us to these concepts. I think it was really helpful. And honestly, when I kind of set out to learn about critical illness insurance, I didn't know how much there was to cover. I think you did a phenomenal job just breaking it down. And I just want to thank you, man, for taking the time to be with me today.
No, I thank you for these insightful questions and just the opportunity to share this. Like I said, I have this weird sort of, obsession with insurance and talking about it and making sure that it's spreading the word, so to speak. So any opportunity I get to sort of share this with whoever, with Canadians, it's really something that I value. So thank you for the platform.
Oh yeah. Hey, it's a pleasure. Thanks for joining me. Take care. Okay.
You as well.
Guys, thank you so much for taking the time to join me again. I can't tell you how much I appreciate it. And I just have to say one thing. On top of all the learning that has come with this podcast, I have to say that probably the greatest thing, the thing that I've enjoyed the most, is connecting with people, like the people who have emailed, messaged, texted me after episodes just to say hi or give feedback. You have no idea how much I appreciate it. And just to connect with so many people, so many of my colleagues across the country, honestly, it means the world to me. So continue to reach out. LinkedIn, beyondmdpodcast@gmail.com. I always love to hear from you. And we'll see you in about 3 weeks. Stay well, stay savvy.